Afternoon, everybody. My name's Rick Claypool. Glad to welcome you in for this conversation. It's a great time to be thinking about where we've been and where we're going. Hard to believe we're already halfway through the first quarter, being in February. It's almost feels like it's like right around the corner. We're going to start planning for 27, right? So let's start our conversation today. Just as a reset on a few things, what might look different than those of you that have attended these before is we are now flying under the banner of Optima FI. Happy to follow up or answer any questions in the Q&A vis-a-vis the brand. This is not a brand presentation, but I did want to cover a couple of things real quick, just to bridge us from kind of where we've been to where we are today. So Optima FI is the right brand. So if you're in this webinar thinking maybe I got on the wrong airplane, you did not. You're in the correct one. I asked you to find your seat and make yourself comfortable. In terms of our speakers today, again, my name is Rick Claypool. It's a pleasure to join. I'm going to coordinate, kick us off, and get us moving, and then turn it over to our amazingly qualified experts, David Ruffin, who many of you are familiar with from previous sessions or from his many years of kind of on tour, on the road, and all the other social events and business intelligence speaking events that he does. David will be leading us through a conversation around credit and credit quality. And what I really like is having Dan Marks as a part of this conversation. And the reason I really like that is it's one thing to look at the balance sheet and get obsessed with what's so about the numbers, and we have to do that. That's our job. That's our fiduciary responsibility. But Dan's going to give us the same view of the world, but look at it strictly through a customer lens. And he's going to provide some really interesting insights in what he's seeing with again, the same sets of data, but looked at through a different lens, much more customer focused. So this is our agenda for the day. We've talked a little bit about Optima. I'm going to hit one or two quick points on that, and then we're going to jump into the rest of this. Just to reset, in terms of what Optima is really all about, this is our mission statement. We believe in this very, very strongly. It's consistent with the legacy brand names that you are all familiar with, or many of you are familiar with. And that's really where we are today. And I just want to emphasize this notion of we really exist to help you achieve sustainable profitability and growth, right? Those are growth, sustainability, and profit are really what we're here to do, to provide you the expertise, counsel, the data management, the ease of workflow and access, really to help you do your job, be a third arm to the work that you're doing. If you are finding us for the first time and you wander off into our website here, or you get redirected to our website, again, you're thinking, am I being spammed? Because we're all bankers. We don't, we have to take lots of training during the year about are we on the right website, or are we going to get in trouble? So if you see this, you are in the right place. And as we go through this today, do feel free to jump in to the Q&A. Or as a follow-up, notice on the top right banner there's a blue bar that says talk to a specialist. That's an easy way to get a hold of us after the fact. You can always contact us directly through any of the various vehicles that we share up today, including emails or things that you've done in the past. But again, our favorite thing to do is talk to you. So we'd love to hear what you have to say. These are some of those legacy tombstone branches, if you will. I think one of the things that we just want to kind of emphasize very quickly, if you're familiar with us, you know this. If you're new to this conversation, you might think, oh my gosh, this is a brand new company. What have they ever done? Well, we're not a startup. We've been living this mission now for 40 years in terms of the various things that we do. And if we think about those legacy brand names and how they translate into how we're presenting ourselves in the marketplace today, you can see that growth really ties back to Infusion, which is marketing services, very customer centric in terms of our go-to-market model. The credit risk component that is led by our friend David Ruffin. The growth piece is, of course, is led by Dan Marks. And then the balance sheet piece that was the old quick rate label. Again, we just brought that forward, and now we're calling it balance sheet because, again, it's providing you lots of really interesting tools to mind and manage your business. And then just as a reminder, you don't need to take notes or take a shot of this screen, so to speak. We'll share this out when we're done. We'll share the deck and we'll share links, and you'll have easy access to it. and make sure that all of the content here as we go through it, there's a lot to cover. So we're going to go at a relatively rapid pace. And as we're doing that, um, again, feel free to take notes, ask questions, etc. But we'll get this out to you as soon as we're done. So as we always like to do, let's start with some polling questions. The first one I want to really kind of focus on is around gathering sentiment. There's a general kind of belief, if you will, that things are trending in the right direction, right? And what I'm most interested in is kind of how do you feel about that? Is that something that you're feeling and looking at? As we look at the numbers today, there'd be a lot of reasons why you might feel good about things. So hopefully everybody can go ahead and see that and start chiming in. This first question, really, I'm going to ask the same thing with two sides of the same coin. The first case, you see that a lot of places are referring to 2026 as a place of a return to optimism. Thinking about the industry at large, this first question really is to focus on what's happening. How do you feel about regional conditions, statewide conditions, national conditions? Thinking about the economy at a macro level, what are you feeling? What are you seeing so far there? In a moment here, we'll wrap this and I'll flip it to the other side of the coin. So in terms of our early results here, I'm getting zeros on very pessimistic. That's a good start. And only 7% are somewhat pessimistic. So that leaves 94% or somewhere in the neutral to very optimistic space. Most of you are in the somewhat optimistic space. So I think that gets into this whole next notion a little bit of how this looks and how this feels very early on. When we think about a return to optimism, I'm seeing a fair amount of people saying they're somewhat optimistic. The number two part of this question, like I said, the other side of the same coin, it's really the same question, but how do you feel specifically about your firm? And these scores, as I'm looking at them now, are actually higher than what they just were a moment ago for the industry writ large. So, in fact, between very optimistic and somewhat optimistic, we're just shy of 80%. So four-fifths of the respondents here are saying they feel somewhat optimistic or very optimistic. Very, very few people are below the line of neutral. So, in fact, only 2% of you. So 98% are somewhere between neutral and very optimistic, which is really exciting. And I think it reflects what we've largely been hearing. You know, Dan and David and I have been out spending some time in the marketplace, spending some time at conferences, and you're kind of hearing that, a little bit of an echo of that, if you will. And so I think where we are feeling more positive right now is reflected in the numbers we're just about to see. So uh, we are saw another really solid quarter in Q4 of 2025. Really, the year is it's got some interesting metrics in it. You may have attended sessions like this from other providers or just looked at the federally available data as it came out most recently. Most metrics improved in 2025. Some of them in a really pretty precipitous rate of improvement, which is really exciting. NIMs are at 3.67. That's the highest it's been in 6 years. So who doesn't feel good about that? Again, this that's the I think a lot of the basis for the return to optimism. We'll get into this very specifically in a second, but what you saw really in 25 was we were able to increase yields on loans, but not necessarily translate that back to improvements in net interest margin. We'll talk about that in a moment. But what I think is happening here is the rate at which people have to overpay for deposits is beginning to dissipate. At the same time, we're still able to increase yields on loans, while those loans still seem to have really strong quality behind them. You put those three combinations together, and you kind of get a sense of why asset values and merger M&A potential values continue to improve as we come through the back half of last year and into this year. And that's, I think, is why you see a little bit more M&A activity. So everything's great. Yes, we all agree. Everything is amazing. It's perfect. It's never been better. One of the little caveats in this, though, is that while loan growth and loan yields are really strong and exciting, there is this kind of natural drag on deposit growth. David is likely to make a comment. I don't want to step on his thunder, but it's been a long time since we've been in a downward credit cycle. Prior to a few years ago, it had been a long time since we had been in an upward rate cycle where people had to learn how to price deposits appropriately. Dan may touch on that in his comments because Dan's point of view is going to be you need to have a customer centric approach to deposit pricing, not just spray and pray rates everywhere, right? He's going to talk about one to one and how to evaluate and segment your best customers and what does that mean and what does that look like from a practical and tactical execution standpoint. So we still have this ongoing disintermediation vis-a-vis deposits. Money supplies is up a little bit, but it's down kind of dramatically after a super dramatic rise in COVID and in the early part of this decade. Um, and then you've got all these other interesting little things. In terms of the online gambling accounts, it's interesting, right? That money ends up somewhere. It doesn't all end up in crypto offshore, although some of it does. But it's really difficult to quantify exactly what that number is. If anybody has a way to kind of get to what that is, please tell me. I have not found it yet, but we know it's happening, right? We actually have, and again, this is one of those things. If you want to follow up with Dan Marks, we have a couple ideas on what you might be able to do to kind of recapture and hold those people that are effectively day trading, whether it's in you know X number of online gambling
Poly,
possibilities and
poly,
sources.
Polymarket, et
Poly
cetera, right?
market.
Rick?
I was going poly market. Is poly market legal in the US yet?
No.
That's where, yeah, that's all right. So that one is going to crypto and it is going offshore and then back into poly market and then it works its way back to us. So that's, I was thinking that too. Yes, exactly. Um, we have a slow and continued decline in the personal savings rate. This will be interesting. I'm going to hit on this as well because I think we've got a missing middle problem kind of in our country right now, vis-a-vis building up stable households that can produce deposits for us that we can lend to. Um, what do we see ahead? Generally good health in 2026. I think, it takes it's not that bad things can't happen quickly, but they tend to happen slowly, the same way good things tend to happen slowly. So economic fundamentals are stable, I think, and trending positive. If you look at the most recent inflation and unemployment data, you can't help but to feel good about that. I think it almost assuredly means rates are not going to go up, and they much less likely to go down at this point in time. There is a possibility, I suppose, if the Fed feels like inflation's under control, so to speak, but that's not going to happen based on the just one most recent reading. And then I think again the big thing that all these things when it starts to add up is I think we can see a continued, if not accelerated, pace of M&A activity. I don't think anybody would be shocked by that. We've been talking about the coming M&A activity for what feels like forever and ever and ever, and I feel like that wave is certainly here. The question really is how big is that wave going to be? So let's look at some metrics here. As we get into this slide here, looking at the top left, and you look at the the asset growth there, pretty significant pop, right? So that's a lot of growth, right, year over year. And we're going to talk about some of the things that are underneath that here real quickly. Relatively balanced by the size of the institution, as you see across the board, and then at the bottom as well. And as that we look at if this is asset growth trends, which is what this slide is focusing on. This next slide here is going to talk about, sorry, loan growth trends. Bumped ahead twice there. So you can see the loan growth, it doesn't necessarily correlate the same way that the asset growth does, but it's still up a little bit year over year. Um, and I think, again, something that I think we're relatively cautiously optimistic about, if you will, right? Um, Interesting the where that growth is occurring and compared to last year and how some of these distributions are moving. We're going to continue to talk about that as we come through the conversation. today, and really how some of these things compare to where they were a year ago. So on the deposit growth trends, um, again, you can see how some of these things are correlated and play themselves out. Um, for the deposit growth, again, in this year, this is 2 consecutive years. But my sense, and it shows up in the numbers, but it's also my sense just from talking to clients and bankers across the country, is again that pressure. It's not completely gone, but the crazy irrational pricing that we were seeing 24 to 30 months ago has abated to a large degree. It's kind of like the water is settling a little bit, and there's obviously still players out there. Some of them out of desperation from a liquidity standpoint, and some of them out of desperation from a wanting to continue to grow their loan book standpoint. That they can continue to get high enough yields on quality loans, they don't mind, so to speak, paying up on deposits. They certainly would prefer not to, but it's not surprising that they would or that they might. When we look at the yields on loans, this is a little bit what I was referring to earlier. Yields continue to move in a very, very positive direction. Again, this is rates aren't moving up, right? We're in a flattened down environment vis-a-vis the rate market, but our yields continues to improve year over year. Obviously, another healthy positive sign. These are the things that, for me, feel like they've been lacking for a very long period of time, where we just, it's going to translate here, it's going to translate here, it's going to translate here, and now it's really starting to. And you've got a 3-year trend, I think, that's certainly meaningful. What's most interesting to me, looking at this slide here, is the bottom left when you look at top cost of funds relative to the yield of loans, right? So that spread is what we're talking about. That's where you get the 3.67-ish number, that is really, really impactful and meaningful in terms of how that drives profitability inside your institution. So there are opportunities within opportunities, right? And so whether that's shutting ourselves from potential problem loans, or whether that is a further optimization of your pricing, every basis point counts. And if you look at um, cost of funds by the group. So, by the way, just to reemphasize this, the PPI is the Peer Performance Index. These are community banks right under, so we're at the under $10 billion range. So we're not talking about poorly named institutions like Truist or other institutions of that scale. Uh, we're really focusing on the community bank market here, obviously. So $10 billion and under. And you can see kind of where the leverage points are as you look at some of these charts, right? Median cost of funds by asset size changes, but it also changes as we think through some of the yields and some of the spreads that are across these things. On the NIMs, this is really where, again, I think if you pick up a bank balance sheet for a company that you don't know for the first time, this is probably one of the first metrics you're going to look at, right? Or maybe along with asset growth and a few other things, maybe efficiency ratio, et cetera. But you're going to look at the NIMs, and you're also going to look at the non-interest income metrics. Um, Perpetually problematic. I think if you go to the bottom right of the 6 year, again, the ability for the smaller institutions to continue to drive fee income, it's just inherent in the nature of the model effectively. I don't think it's a management performance issue by any stretch. I don't think it's a pricing issue by any stretch. It's just kind of inherent in terms of like where you are on your growth curve and what are you effectively able to charge. And do you have a diverse enough business mix and product mix where you're generating a fair amount of fee income, yes or no? And those things come with scale for sure. Over 10 billion, of course, those numbers go up even higher. That the 58 basis points on the bottom, the top blue bar on the bottom right chart, they continue to improve if you get over $10 billion. So again, highlights to me here are on those left sides, those two kind of aquamarine colors, noting that there's just not a lot of leverage right now in non-interest revenue, but that improvement year over year in terms of the net interest margin, I think, is palpable, meaningful, and really drives right to the heart of what we're talking about, and why we have some optimism. When we look at efficiency ratio, so this is where a lot of the stuff starts to translate. This is why, again, if you're just don't really think about an industry or I'm sorry, don't think about an individual institution, and you're focused on what's happening overall, and you see efficiency ratios improving like this, that's a pretty exciting thing, right? Not surprisingly, if you go to the right side, again, this is one of these things where just scale matters. And I think this is what's really ultimately going to drive further and further M&A activity, to the degree to which you have a solid base of core deposits and a demonstrated ability to grow those things, and you couple that with some franchise value. The question really becomes, can we continue to grow this thing organically, or if somebody's going to come along and pay us, X plus prime on book, those are some of the questions we have to face right now. And more we're seeing that out there. That's not a bad thing to have, right? Like, a marketplace that wants your equity is way better than a marketplace that doesn't want your equity. But I think it creates new and different challenges. If you want to stay independent and you want to optimize the numbers on your sheet, you need the tools, you need the insight, you need the advisory services, and you need, the SaaS and data tools to help you really optimize these numbers. And I think, you know, some of it always is regional performance, and some places you just get lucky if you're in the right part of the country. The rest of it really is hard work and kind of an everyday approach to what we do. Just wrapping up this section here, a couple of key things. Big jump again on ROA here. Core earnings, you see the same phenomenon passing through. Um, Not bad, right? 35% of our institutions at this point in time, if you look at the top row middle chart, 35% are above 1.5. It's been a moment since we've seen that, right? It's been a moment since we've seen a 1.29 number at the median pre-tax ROA. Obviously, those things translate down into the core earnings as well. But then when you think about ROEs and stuff like that, it gosh darn better translate down into the ROEs, and of course it does. Bottom left here on the aquamarine, again, you can see highest it's been in 3 years. And I'm interested in having this conversation with y'all again in May, because I think we're going to see a continuation of this pattern. There's nothing to suggest that we're not moving into what will be the new top end of the range, right? And, we're not going to get ROAs of 3.0 for all eternity. We're not going to get that high. That's not what this business is. We kind of know what its limits are, but we're not quite there yet. I think we're moving in the right direction. And Dan and David and kind of what their comments are going to be, they're going to hit a lot of those things. Just to wrap this section up here and move it on, just a couple of key things. There's a lot of data on this. Again, this is why we share it out after the fact. But on first and foremost, everything we've been looking at has been looking at the median value. We focus on the median value. What this does is kind of give you a stretch, and gives you a sense of what the range is here across each of these metrics. When I look at that third block down in terms of profitability trends, every single one of those is moving in a positive direction. Every single one of those is better than what they were, a year ago. So whether it's ROA, core earnings, ROA, ROE, every one of these things, it has improved from a year ago. When we look at asset quality trends, net charge-off ratio is only at 2 bips. At the high end of the range is 35. But that 2 bips is effectively unchanged. I think it was 1 this time last year. Doesn't mean there aren't concerns, and I know that David's going to talk about this. This is the time to, it's kind of like if you've ever been to the ocean or the shore, depending on where you are in the country and what you call it. That you see the storm over the horizon, right? You can see it coming, you can see the lightning. Is it going to pass by us or going to hit us, right? And the best thing to do is take proactive steps now to shore up both your asset quality, and then again, as I mentioned, what Dan's is always hyper focused on, but how to shore up your deposit quality with a customer-centric lens through which you look at the world, not just a balance sheet lens. So that said, I'm going to turn this over to David here in just a moment, but first, I've got one more poll question. This time I want to talk a little bit about credit quality. And if I can just get Zoom to behave. There we go. One second. All right. Is your poll question up?
Yep.
This one's asking about your prediction for credit quality in 2026. Early returns here is about the same, is dominating uh, the results. Fair amount of commentary around segment specific, which again, I think makes a lot of sense, right? It's one of the things we always try and caution people to think about. Um, and I know this audience understands this, but a lot of times people want to jump in and they say commercial lending, and it's like, well, what are you referring to? Like, there's a lot of times of lots of types of commercial lending. All right. So sharing these results, can y'all see that? So about the same, a little more in the deteriorating. Um, I don't know if it's true or not, but I always like when bankers are concerned that it might be true, right? It's better that we are thinking vigilantly and being good pessimists when it comes to underwriting. So I think we're doing a large majority of the folks, obviously 52% are in here in the about the same. So with that, David,
I
I am going to turn to you.
Yes, and I will. I do appreciate that. Particularly appreciate. Hopefully, you can see the slide being set up like you did for me, Mr. Claypool, and that is all the optimism and all the cork popping of the champagne bottles about how great the industry is. Of course, you're going to expect the credit guy to come in and say, "Oh yeah, but, oh yeah, but, oh yeah, but." But anyway, for my own credibility, as I've said before on many of these quarterly webinars, yes, indeed, I acknowledge the benign nature of the current credit cycle. I've been in this industry many, many years, as Rick already alluded to, but undoubtedly this is the longest benign credit cycle we've ever experienced in 50 years or more. So no question that that exists. But again, the age-old caveat of vigilance, I think, is necessary. I did speak at the Acquired or Be Acquired conference a couple of weeks ago in Phoenix, which of course is a confluence of commercial and investment banking. And there was no question about a lot of the things that Rick has already alluded to in terms of the stellar performance of the banking industry, and where it finds itself today compared to the last few years. But I think there was also a recurring theme, even among the most optimist speakers, that we always have to recognize the big elephant in the room is asset quality. And of course, there are some uncertainties that are still at work in the broader economy in terms of uh, you know international issues, policy directives, and what have you that always have some spillover effect into the economy from either short or intermediate terms. One of the things that is emerging in commercial loans, they're very stable. The numbers that we're going to talk about today showed almost no movement between year-end third quarter and fourth quarter 25 in terms of any concerns. Again, reiterate, these are all numbers for 10 billion and under banks. There is some concern emerging, and I've been sharing this for 2 years on this webinar of some deterioration in multifamily. and that's beginning to actually show up. And some of the more leveraged corporates that are showing up in some of the more specialty lending in some banks. I do think that inevitably we have to accept the reality that we are still living in a somewhat accelerated, what so to speak, K-style economy, where there is a delta continuing to grow somewhat between the paycheck to paycheck and well-heeled borrowers. Um, Interestingly enough, I know there are bankers on this uh, webinar today, but the issue is the credit unions are really showing major stress and some indication of credit quality in their portfolios, but they've actually begun to improve on some of their consumer. The banks are in a little different. It's consumer lending among the banks that is giving by far more concern. I have a theory on that because many times credit unions, smaller credit unions, are still in that kind of face-to-face lending. They don't automate to the level that banks do in terms of credit card decisioning, or excuse me, consumer decisioning, whatever the loan type is. But I do think again, there's some clearly increasing stress in some of the consumer products, particularly in the banking world. There is still this disproportionate exposure of CRE lending at the community bank, community financial institution level that I think we still have to keep an eye on. And largely because that undoubtedly is the most illiquid of all problem loans if it becomes that. There's again consistent concern, not necessarily directly impacting the audience today, but the potential for some of the private credit deterioration that could have some systemic effect on the financial industry. We still see some risk grade migrations in our loan review work that are beginning to tilt a little more to low pass. I do hasten to warn some bankers to be careful not to overload their silos, so to speak, or buckets of low pass out of just conservatism, because it's been my experience when if we did have a significant amount of increased credit stress, it makes it more difficult to ferret out where the real weak credits are. So keep an eye on that. And I'd like to mention that a little bit before I finish my segment. And again, regulatory scrutiny is changing. Boy, that is a changing ball game. And I do want to talk about that in a little more detail in just a moment. So the numbers we look at here, as you can see, a lot of this is backing up what Rick has already alluded to. You see some 3 years now of trailing off wholesale funding from the peak of 2023, which we all know what occurred that year in terms of the runoff of deposits. You've got, in terms of gross loans to deposit, you also have regional differences there. And particularly, you've got the Northeast that is disproportionately using more wholesale funding. And then you've got your, loans to deposit, which have been basically standard. There are differences in the regions, but the national average on loans to deposit has really not changed in now almost 3 years. This is the chart that, again, I've alluded to before that concerns me, mainly because if we did get into heightened credit stress, there is going to be disproportionate pressure on community financial institutions to stem this trend. And the trend, of course, is the chart to the left indicates increasing, while not by historic standards, there's certainly trends in a trend sense, certainly increasing NPLs over the last 3 years. The corollary to that, of course, the way I like to look at it is, okay, that's your inventory of acknowledged problem credits. What is your reserves coverage to that? And as you can see, that trend line is going exactly the opposite direction. The reality is that the mega banks, or the larger regional banks and mega banks, don't experience this kind of delta in those trends. They basically kept reserves in many ways proportionally in place after the pandemic that community banks tended to pull off the table a little bit, somewhat understandably. But this would become an issue in terms of pressure on community financial institutions to buttress their reserves, if indeed. I will say this, Rick, and I agree with you generally on what you said about things tend to move slowly. But what I have experienced, and particularly what I think would happen, given the incredible length of this benign credit cycle, is that there could be a panic that sets in terms of a sense of through the investment world and the regulatory world that, oh my gosh, goodness, we're having some credit stress. And then that kind of carries a momentum in and of itself. So there would be a potential, even beyond the numbers themselves, a psychological sense that, okay, we better start putting more reserves in, and that there does have a little bit of a downdraft psychology if we get into, arguably or demonstrably heightened credit stress. Again, this is the more traditional way we look at it in terms of your ACLs to loans. There is an interesting dichotomy between the banks in the western regions versus the Northeast. It is interesting to me that as you saw in the Northeast banks, they were also the banks that were more dependent on wholesale funding than the national average. But that's a pretty big discrepancy regionally between the West and the Northeast banks in terms of your traditional coverage of loans, reserves to loans. Texas ratio is something we don't talk about until we get into credit stress, but as you can see, it was, of course, a shorthand for during the financial crisis of how a bank was managing their credit quality. But again, you can't deny the trend here is that it continues to show upward stress a bit. Again, not anywhere near where we were during the depths of the crisis, but it certainly does show a trend that we need to look and keep an eye on. In our more traditional way of looking at exposure to CRE, which is important because most banks on this call today have significant exposure to CRE. It's been, the go-to amount of type of lending for frankly community banks for now arguably 40 years. So we understand that, but the reality is has been some concern about the concentration of CRE at some of the smaller banks. It is interesting that the construction and development, which is the subset, the one that the guidance asks for 100% or identification of banks that are at 100% of their risk-based capital in construction and development lending, that's begun to tear down marginally in the last 3 years. CRE as the broader category, which is of course the 300% guidance, that's showing a little bit of an uptick, or really more flatlined a little bit, but it's an uptick, particularly again in the West. Again, multifamily is the only subset kind of loan product that I've been the most concerned about, frankly, the last 2 or 3 years, and that does still show a little bit of drift upwards in terms of exposure. We're seeing some examples in some of the even dynamic markets that we do loan review for, that there's increasing issues of 3 and 4 months promotions for free rent, which tends to be a telltale sign of a supply and demand issue with that. C&I has again leveled down to where, after the PPP programs, and of course, ag has been pretty flat. Naturally, Midwest banks is the upper line, and the yellow would significantly lead the rest of the nation in that. These are not farm credit system numbers integrated in there, strictly commercial banking. I mentioned this a moment ago that we're in a new ball game for regulatory. I think one of the reasons for the optimism, frankly, in the industry is what is broadly perceived as across the board regulatory relief that came inevitably with the change in administration. In fact, you could argue this is the most impactful change in regulatory mindset in 20 years. Obviously, things like this CFPB were almost immediately affected. There's been suggestions of reducing the community bank capital ratio down from 9 to 8%, indications already that they're expediting M&A approvals. They've removed climate change and reputation risk from the general assessments of scoring banks during regulation, or excuse me, during examinations. There's been a general promise to streamline regulations for non-systemic banks. The net effect of that, it seems to me, is that under the current regime, there's going to be a lot more pulling back on process examination and much more focus on performance. And this is why I want to mention how does this affect credit? Because the good side of that is I think it frees a lot of bankers to say, live by your own wits. You've trained as a banker to run your bank to avoid getting yourself in a ditch over risk issues. Now you should be given some more latitude to manage that instinctively and intuitively. But I do think one of the things you'll see in most immediately is there have been estimates of up to 40% less headcount. Some of it was Doge related, but everything I've been hearing from people that I stay in communication with the regulatory community is many of those people will not be replaced. That will have a significant impact on the pace and frequency of in-bank examinations. Um, there's an inevitable question that's uh, raised in that is, will all of this lead to riskier lending? Certainly, again, I would hope that banks wouldn't fall into that trap because we know where that went 20 years ago with all the bank failures. Um, but again, I think all of this, and again, Rick alluded to it, is with the backdrop of this incredibly long current credit cycle. And cycles are named cycles for a reason. They never stay permanent. It's always going to be a change somewhere. We don't know when that is. So I do think we need to keep that in mind. Um, there has been a dependence, I think, in the last certainly 15 or 20 years with the intensity of the bank regulations to almost look to examinations as report cards for the performance of your bank. And I do think that's going to move back away. And again, in many ways, you could say this is freeing us to kind of run our own banks or run our banks the way we need to run it in a disciplined way. But I do think it's going to put more focus, on management and boards, and frankly, trusted vendors, uh, and not to just through a kind of de facto presumption of what the latest exam showed. My sense is what I'm hearing is that they're going to focus a lot on call report trends and that type of thing in terms of where the real intensity is on examination work. But I think I'd like to just remember or remind people on here again, enforcement and economic cycles change. They always do. And credit's a long game. We've talked about that in the past. It doesn't just turn on a dime. So again, in kind of conclusion from this segment, our primary focus at Optima FI Credit Risk has always been kind of these three pillars of post-booking risk management, which of course are uh, loan review, portfolio analytics, and stress testing. I can't help but say that these are still the age-old go-tos to make sure you're maintaining your proper risk management going forward. And we're particularly focused at this particular point in time is to try to put stress testing and loan review much, much more aligned together. Uh, we don't, many of us have to do stress testing or do stress testing, but are kind of, you know, dismissive of it because it's so theoretical. This is an example where we like to say it can become much more practical when you companion it with a loan review because it then identifies explicit credits that may be suspect credits or may potentially put your bank at greater risk upon the realization of heightened credit stress. So again, I'll just close by saying, yes, I'm the predictor of I'm the predictable credit guy. If things are great, things are still good. However, keep an eye on it. And
Until
again,
they're
I
not.
and I do real and even Jamie Dimon, who's obviously a very high profile individual in our industry, says rather aptly, we've had a credit bull market for many, many years, and the prediction was, and I hate to acknowledge he's right, if and when we have a downturn, we're probably going to see quite a bit more credit issues. So again, I appreciate joining with you again. And at this point, I'm delighted to hand it over to my friend Dan Marks.
Thanks, David. And I think we got the last set of polling questions quickly. Um, so, Rick, I was just thinking about looking at the clock. We only got about a quarter of the hour left. Do we want to, can we quickly do the polling question or do we want to skip that in the
We can
interest of
skip it,
time?
Dan, if you're okay with that.
Yeah, let's do that. I think, the sentiment, I think the sentiment question, the credit question, we already talked about it. Rick gave a little more background. The perspective from the customer that we bring to bear, beside just the fact that we're all bankers, is some very granular customer level data that has a very good coverage across the nation. Um, and there's a macro database that we're going to be pulling from. It's the old Infusion norm, now Optima FI norm database that covers household behavior of over 50 million households, and then also specific campaign strategies, treatments, responses, analysis at kind of a granular tactic level or campaign level, um, also across millions of records. So it's this great top-down perspective and then very tactical bottoms-up perspective on what consumers and businesses are doing relative to uh, financial behaviors and how they interact as customers of banks. Um, so that's a little bit more perspective on just the information we're pulling from.
Hey, Dan, you're not
Um,
sharing your screen.
oh, thank you.
You're welcome.
I was jumping right in. There we go. All right. Yeah, so the backdrop and the good news is, Jen, you caught me just in time for the slides because the perspective that we have, and Rick talked about this, is that deposit growth sort of varies. The good news is if we look back over the last 25 or 30 years across multiple cycles, is deposit growth always grow. You sort of toss out the anomaly that was 2020 and the follow on. Um, and really the post-war, if you went back even further, the post-war deposits are growing, but the level of tailwinds in the industry does significantly vary based on the interest rate environment. And so, you know, as rates come down, we do see typically deposit growth, kind of natural growth lags. You might say that's kind of the intended effect of pulling liquidity out of the system and slowing it down. And so I think the key takeaway is, in this changing environment, really drilling in, understanding what's happening at kind of a macro or micro level at the customer level is really important. And so how are consumers and businesses responding to the rate environment? How can we then position for success against it? And so one of the points of view that we look at is just what's happening in consumer household checking, right? So this is, of course, the barometer of the health of the consumer. Businesses, of course, serve the consumer. And so we see really kind of core liquidity as evidence of both the penetration, but then also the average balance in consumer households held at U.S. community banks is really stable and increasing. And so that's certainly increasing on a total level, and then it is driven a little bit by interest checking. So the average penetration of interest checking has crept up from 2 or 3 years ago in the 24 handles to now in the 26 handle. So and approaching a 27. So as we went through uh, so long with basically no rates, right? We had our own sort of mini Japan scenario. Rates then popped up in the a few years ago, have started declining, but still relative to several years ago, the fact that someone can earn an interest on even their core operating funds is a different. And so you're seeing consumer behavior change shift. But if you look at the flip side of that metric, 75% or 73% of households, U.S. households, do not have an interest checking. So that's your non-interest checking. Of course, business is DDA, and so there's a great stabilization of funds in that core checking account. What's happening on the interest-bearing side, CD, average balances held with CD households have risen dramatically, almost 20% in the last couple years, even while penetration has sort of stabilized around that 10 percentage point. When there's nothing to be earned on a CD, people just left it in their checking account of their savings since the return of interest. But again, CDs are a niche product. So only about 10% of households have a CD with a US bank, which means that it's going to be certainly very relevant to some consumers, but there's a whole bunch of consumers where a CD is just not relevant. And so if you're thinking about kind of the old days of plastering CD rates everywhere, that actually ends up or becoming not relevant to the group of consumer that's never going to use it. Money market trends are also kind of the flip side of CDs, right? But again, one of the things to consider is only about 7% of U.S. households have a money market. So now, of course, a whole lot of people just don't have any material savings vehicles. They don't. That's the flip side of the paycheck to paycheck living. But even a money market and a traditional savings, of course, would have a much higher penetration than money market. But again, this is a product that is used by a relatively small percentage of households. Now, the nice thing is the balances held are really high and fairly stable in the interest rate environment. And so when you think about tactics to use, being targeted and reaching the specific businesses or consumers that have that, we talk about a capacity or the ability and a propensity or interest, there's really good payoffs. Now, the flip side of the tail of the changing tailwinds are, in 2024, it was very easy to raise deposits by advertising a CD rate. Rates were kind of in an upcycle. People, were not used to earning rates in a near term on rates, and so we were seeing average response rates of 7% on CDs. That's really reverted to the long-term norm. So on a very long-term basis, we see about the average response rate for targeted CD campaigns is about 2%. So we're back in that range. Money market, though, is elevated, and one thing we saw that even after the bump, money market savings is higher, 2%. Now that's great from typically a total cost of funds, but also from a liquidity. Now, the reason consumers are still more interested, all things considered, in the money market is because it's liquid, and they know that in a dynamic rate environment. And then we look at loan credit. So I think there's definitely sort of a good balance of perspective of underwriting. So I at least don't see evidence on the consumer side of massive getting out of our skis. But there's really solid demands, and so we see growths in terms of average balances on using of unsecured or real estate or auto-secured loans, although there's really not material auto-secured at banks where the average balances are increasing. Home equity balances are creeping up, but on an average household basis, very moderate from a historical perspective. Consumer credit card is an interesting story, and so we did include a comparison to credit unions because banks compete with credit unions, but we don't really see a very high percentage relative to at community banks. We see about 3% of households that are customers of community banks having a credit card with that bank. But credit unions is a totally different story, almost 20%. And so credit unions are and maybe that's a difference on a risk appetite perspective. But when you think about a kind of a more moderate growth cycle, um, that's something to consider is where there's a good platform, you can compete against the monolines. They're a great source of fee income and relatively higher yield in an overall portfolio perspective. And then, so the last thing I'll just mention in this section as we look at time is we are seeing a kind of a rising interest in credit. And so uh, now banks tend to have a little bit lower response rate, higher average balance than credit unions. But the key takeaway of that right hand chart is that banks have a very solid response rate when they do properly targeted outreach. And so that's a great way to control your credit risk. Obviously, there's a lot of regulations to consider in terms of fair lending and those kind of things on this front. But it's a great you can be very targeted in outreach to make sure that you're reaching people that have the capacity and propensity for um, the right kind of loans that meet your credit appetite. And so, that was a very quick kind of trends overview. If you wanted to dig into any of this information, we're available to work and really dig in and say, what are the statistics of your own institution? What are those deposit optimization opportunities, the low cost deposit growth, the lending growth? And it's a great value to understand comparing to your peers, what are those opportunities and risks on a one-on-one basis. So Rick, I think back to you. Try to land the plane, 2 minutes to go.
All righty. Thank you, Dan. So, key thing, do we see the screen here? Let's meet again in May. Just to reemphasize what Dan was finishing there with, his point was, that last piece is complimentary. That's your free gift for being here today. We thank you. We're right at the hour. Apologies for going a little bit long. We'll see you again in May. Kind of big takeaways, good momentum, some dark clouds, darker if you're a credit person like David, but that's okay. We like that. Pessimism's a good thing. Be vigilant, stay ahead of it. And this is one of those, if you're in a good health situation, now's the time to kind of maximize that and make sure that your health doesn't slip, slide, or anything else. Got a lot of thoughts for you in terms of follow-up. We will get this document out to you. Thank you so much for your time and attendance today. Appreciate everybody. Take care.
See you.